All right, get started here in a quick second. Can you guys hear me okay? We'll type here in the live chat. Cool. Cool, cool, cool. All right, give me 1 second to have people kind of join in here and we will get started. Okay. Let's get started. If you guys have questions as we go through this, just type it inside the live stage. For anybody that's coming in on the public stream, you might be able to drop comments and I'll be able to see them. If not, join the Discord. It's in our previous post here on the Options Depth feed. Again, today it's just basics, right? A lot of new people, a lot of new faces over the last week asking about all of this information and kind of how we trade it. And there's some good things to kind of take a look at from the last couple of days, as everyone now has been talking about gamma. And I'll be honest, vast majority have kind of explained it wrong or have overcomplicated it. So that's what we're going to focus on today. If you guys already know the basics, none of this is going to be new, but this is the primary focus kind of going forward here. So first and foremost, something that you're going to have to understand and know is, why do we even care about all of this? Why care about gamma? Why care about gamma on SPX? And we care about it because of delta hedging. So one thing you have to understand is when a market maker takes a position, in particular on SPX, they instantly hedge it, right? And they hedge it inside of the ES futures complex. Okay. Then after that, all of these positions that customers put on and what's the counterparty, which is the market maker, all those positions have something called delta, right? And dealers are all about delta neutrality. So what they're trying to do is hedge their position based off how the delta changes. Gamma, being a second order Greek of delta, is the acceleration of delta, right? So when you're in an area with a lot of gamma, whether it's positive or negative, and we'll get into the differences, that determines the hedging effect that it's going to have, right? Sometimes they're going to hedge with price, sometimes they're going to hedge against price. It's not a very difficult concept. It's very simple, especially when you're looking at the platform here from Options Depth that shows the different pockets that you have of negative and positive gamma and the values of those positions. Okay. So if you understand the basics of delta hedging, right, then you can understand why we care about this. Because if you have signed SIBO data, which we have here from SPX, you can understand the inflection points of the market and where price might accelerate, price might slow down, and where you can potentially, develop trade theses and ideas to be able to make higher conviction trades. Okay. So first and foremost, you have two basic gamma concepts that you need to understand: positive gamma and negative gamma. And I'm going to show you what this looks like on this dashboard in a 3D image. Don't get scared. I know this is going to look like, something out of the matrix, but it's a very simple concept to understand. Positive gamma, right, means that dealers are going to trade against price. Negative gamma means dealers are going to trade with price. That right there is the core competence of what you truly need to understand. And the way to visualize this is in a 3D lens. Okay. So if you look at over here on this top right side on this 3D map, you'll notice this massive gamma peak, right? That's blue. That's positive gamma. So when you think of price going into an area of positive gamma, you want to think of it as going up a hill, right? And the higher the gamma values, the larger that hill is, to the point where you get to the peak, which I would call like a mountaintop. Think about it as if you're running across that landscape. Is it easier to run up a hill or down a hill? It's easier to run down a hill, right? So as you're running up this hill, or you think of it as if you're hiking, price is going to slow down. It's going to quench volatility, right? That's what we're looking for. And why does that happen? Well, if we understand from a delta hedging perspective that as we get into positive gamma territory, dealers have to hedge against price. Now you understand that the speed has to slow down as they hedge against it. One key competency for this, though, is that you have to understand is gamma is not directional, right? It just tells you what dealers are going to have to do from a delta perspective as price changes. Price action is what really reigns supreme. And we'll show you examples of that from today and from Friday with the JPN caller, so you can better understand that concept as we go through this. So just understand, you're trying to find points of inflection here where you can understand, well, hey, this price might slow down as we get into this positive area, or price might increase, or speed might increase as we get into a negative area. So as we talked about going up a hill on the positive gamma side, we'll talk about what happens on the negative gamma side. And you could see it here, right? Look at this negative gamma pocket, right? It's into a valley. So think about, again, the analogy of running. What's easier to do? It's easier to run downhill. Or better yet, think about it with a ball, right? What are you going to do if you try to push a ball up a hill? It's a lot harder to do than if you were to roll a ball down a hill. That is all you really need to understand to just get the core basics of gamma. People like to overcomplicate it. People like to make it really confusing, but overall, it's really simple. So when you look at this landscape from a 3D lens, right? See that big hill, you see the big valley. All of this is now put onto the 2D map. So all you're seeing on the 2D map is an easier representation of the 3D. So when you see this big, huge red circle right here towards end of day, you'll understand that this is a deep valley. And when you see this big blue blob up at the top here, that's positive gamma, and that's like your big peak or your mountaintop or the top of a hill, right? So all of the 3D just gets overlaid onto this 2D map. Now, how is gamma created, right? How does this even happen? How does this map get generated? And it's generated off of customer positioning. So if I were to look at what I have here and I scroll down, I have a breakdown by strike for today's action on a 0DT basis. And the left side, this is all customers. This is customer positioning. Right side, this is customer positioning, but on puts. So green calls, red puts. On the middle, I have the market maker positioning. Now I want you to look at what we see here. If you look at the left side here on the calls, you notice how customers are short the 6580 calls. So if I go over to the other side here and I look at the market makers, it makes the market maker long the 6580 call. They are taking the opposite side of the trade, simply put. So if anybody who shorts calls from a customer side creates long or positive gamma for a market maker, and anybody who buys a put or call creates short gamma for a market maker, right? You can see that here, 65.95. There's a customer that's long that call. That is creating negative gamma up here at 65.95, right? That is the basic core competency of how this gets produced onto a heat map, right? And we can take advantage of this. So one thing to look for is, where are the big positive levels, right? If we know that price has to slow down as dealers go against it, we can see those as potential resistance levels or potential support levels. So when I'm looking at this positioning right now, I can see from a sizing perspective where those potential areas are, right? So right here, 65.80, this is a positive gamma node. We might slow down as we push into this, and price action will have to want to absorb the dealer hedging as they sell against price to push us higher. And then you can kind of see it down here, 64.50, right? The in-between with all these negative gamma levels, sure, if they're large, we'll call it like a high sensitivity node where there's a lot of things that have to happen, right, from a hedging perspective, but they're going to trade with price, which is what you see on the map. So on this, if we kind of show you what happened today, and then I'll go back so you can see what happened on the caller, because these are good ways to explain all of this. Let me go back and refresh. Okay, we're in negative gamma territory. So if I go back to the start of the day, and you can see how the positions were kind of sitting here. We don't have a ton of 0DT yet because they haven't been layered in. You can see that on the right. But you could see that we're going to open up as we did in negative gamma territory. So you know throughout the day today, as 0DT positions come in, we are going to be in a negative regime, which means the potential for more speed and volatility. Okay. That's what you're getting. That's what you saw here, right? We saw this kind of bid higher. Dealers are going to trade with price in whatever direction they decide to go. We could have easily sold, right? That's the one thing you have to take from this. Just because we're in negative gamma doesn't mean we go down. And just because we're in positive gamma doesn't mean that we go up. That's what you see a lot online. It's nothing like it. Gamma is just how delta is going to change, and it's just reactive, right? So if price action wants to go higher, it's going to go higher. And you know whether or not dealers are going to sell against it or buy with it. If they're going to buy with it, you have the potential to ride the momentum. You could see that today, right? If I zoom in a bit on this chart, and let me go a little bit earlier in the day or into the session, you'll notice that we had negative gamma when we had a headline kind of came out, a catalyst right around here, right? So there was a nice catalyst and we pushed higher, right? And because dealers now are going to have to rapidly hedge against their delta that's changing on their books as we got that pump, they're trading and buying futures to amplify the move. So you see the amplification here. We went from 65.30 all the way up to 65.99, so 6,600. That's 30 handles in, I don't know, 10 minutes, right? That's a lot. 70 handles, sorry, in 30 minutes, right? That's a lot. That's a lot of speed and a lot of momentum. You could have played that. Then we sold on the next side and we came down in the same way, right? Just because it's negative doesn't mean that we're going to go up or down. We're trading with price action. So once they started to bring the momentum back and sell off a little bit to bring us back down, you had that increase of speed on the downside, right? And you could see that in this candle. So that's all negative gamma is, right? Is just your understanding that when price action wants to go somewhere and you get a bid or you get a sell off, we're going to trade with price. Dealers are just going to trade with it. In the same way, if we do nothing, right, as we chop around, we do nothing and no one's really buying or selling because it's lunchtime and all the big wigs are out, having lunch or however you want to say it, right? Doesn't mean we have to go anywhere. We can sit in this range, but they're still going to be trading with price. It's just there's not enough price action to move us in any significant way right now. So that's the one thing you have to gain and understand from this. So when you think of negative environments, you think of unstable. When you think of positive gamma environments, think stable, right? That is the easiest way to really understand that. Ronch is asking, he's trying to refresh all the put and call data. Yeah. So if anything ever gets out of whack on the platform, just reset it, right? So you just come in here and reset your angles. Reset it and then readjust to what you have. Or what I typically do, in all honesty, is I just change the range manually at the bottom to what strikes I want, right? So 6,300, 6,700, if I want to increase that or go, I will do that myself. Okay. Any questions so far in the chat, public stream? Are you guys understanding the basic competency? Cool. I know some of you have been listening to me say this for now, which is great. So that's the basics. When people get confused on the basics, if you just understand that, it's a good place to start. Now, there's a secondary thing to pay attention to, as pointed out in the chat here by Kakashi. He's asking about charm was plus V. Does this mean we can ignore till end of day? I'll get to that in a second. Let me finish with the basics of the gamma stuff and some of the positioning first, Kakashi, and I'll get into that. Tim is saying, so on the left is puts in green. Yeah. Okay. So on the platform itself, you can adjust what you want to see. This is just how I like to see it. I like to see the customer positioning, and there's a reason for it. I like to see what they're not necessarily betting on, but kind of sometimes there's a little bit of a directional bias. Sometimes there's not. And I just want to see what they're doing. Today's an example of this, right? So I have this set to position number, 0 DT expiration, customers. And remember, market makers will be the inverse, which is why I have this here. If I go back to early on in the day, I want to point out a couple things that happen on why I look at it this way myself. Okay. So let me go forward a little bit. Let me get to the open here. Okay. So I want you guys to watch down here on the call side. Remember, this is customer end. Boom. So 10 minutes off the open, someone came in and sold a 65.45 by 65.65 call spread. Okay. So that to me is like, okay, someone is betting that we do not go through their 65.45 strike and they're trying to collect premium. Does it mean that we don't go through it? No, it doesn't. It's just what they're betting on. So I like to pay attention to it. Then on top of it, because of how the width of it, I know that this short call right here that we see is going to create positive gamma on the book. And I'm going to pay attention to that as a level. Now, one thing to understand is with how gamma works, it is the largest at the money closest to expiration. And you can see that on the map. This screenshot is 10 minutes off the open. Don't pay attention to the candles for now. I'll remove them. But this is 65.45, that sold call they have right here. See how it's pushing out just for the last hour onto the map, right? The size is not large enough to push out onto the entire map because the map is based off of all the positioning, right? So again, since 0 to T is the largest from a gamma perspective, it will push out and maybe sometimes take over, but not enough. So I look at it and go, okay, well, that's an area of interest, but it will be a stronger support or resistance level the closer I get to end of day, like the last hour. So I'm just going to note it. I'm going to mark it. There's potential there. But again, in a headline driven market, anything can happen. Okay. Now watch what they did throughout the day on the positioning side. We moved higher off all the Trump stuff, and you're going to watch this guy close his position and roll it higher. I think he did it after we got the pump, so we're going to go up a little bit. And then I'll show you the collar stuff because I know that's what everyone's been talking about, and there was a really great trade off of it if you were paying attention. So keep watching the positions change. Boom, they closed it. So by 10:50, they closed out the position, right? They didn't like that we got a pop. They were in max pain on their trade. So they closed it. And then if you go the next 10 minutes forward, they reopened it higher. Now I'm making an assumption it's the same person. And why? It's because the sizing is the same. And I've been watching this guy come into the books selling put spreads and calls. And I don't know if it's Condor Man trying to do stuff for someone else. Doesn't really matter. I just know that someone's betting or trying to bet on the fact that we stay in some sort of range. Any catalyst in a negative gamma environment, though, wipes this idea out. And it did. Got wiped out again today and had to roll up higher to try to catch some of that premium. So that's why I look at it from positioning. And then I look at it from the gamma perspective, which is how I showed you guys how it pops out onto the map. Okay. So you could set this any way you want. I just prefer to see the markers so I can see as people get in and out on the call side and on the right side puts. And then you could do whatever you want on the market maker end here. This is net positioning because that's what creates the gamma. Or you could see calls and you could see puts. You could see net. You could see all of it. It's entirely up to you. That's the point of how the platform is designed. It's your flavor. Some people that I know look at the positioning and they make trades off of that, and they don't look as much at the gamma side. They care about the actual SPX positions. Others don't care that people are selling spreads and care about the gamma implications. So there's a flavor for everybody. Okay. All right, so that's the gamma side. All right, I want to show you guys before we dive into the charm end what happened on the collar, because this is what everyone has been talking about and everybody has talked about it for the most part incorrectly. And I don't mean that with disrespect. It's just the truth. Okay. Wrong day. Okay, so let's go look at the collar. Everybody knew that the JPM collar was going to expire on the 31st. None of that is new information. Okay. Everybody knows that they put that on an SPX. They've changed it now. They're not using SPX options, but for the sake of what we're talking about, it doesn't matter. Okay. So we know going into the day that 64.75 is a massive negative gamma level. Why is that? Because you could see it right here, right? So you have a customer long put position from the collar, right? And remember, they take the inverse side. So if a customer is long the gamma, the market maker will be short the gamma. So you see that here, they're short the 64.75. So we know that there's a lot of hedging that will have to happen in and around this strike. Why is that again? And I'm going to repeat myself. Gamma is the largest at the money closest to expiration. And it works not just on like a daily basis, but even on an hourly basis, right? So 1 hour to the close versus 5 hours to close, the gamma levels are completely different, right? So if we look at what happened throughout the day today, we know we're in negative gamma. They're going to trade with price. And then the trade that most people, I think, took, if they could read this properly, was a momentum trade off of this map. So let me bring it up to when this kind of happened. And another thing to remind everyone and point out If people pull their positions off, the gamma map changes, right? So, and I could show an example of that, it'll be helpful. But we know that on this collar, they're not going to take this position off. It's static, it's staying there. They're not taking it off. If this position came off and they closed it, that negative gamma goes away on that strike, right? And there's a hedging effect that has to happen. But if you move forward into time, you guys are going to notice right here, we still have all that negative gamma, and we caught a bid. There was a headline. Iran was saying, hey, we want to make a deal. Markets rallied off of that. Not only did they rallied hard. And part of the reason was because price action wanted to go higher, but more importantly, from a dealer hedging perspective, they have to trade with price. And remember what we said. When we get to that strike, gamma is going to be at its highest. So there is a high sensitivity on that level where if we get above it, there's a lot more buying of futures they're going to have to do to continuously hedge it. And as we go up, right? So on that end, you could see it, right? If you caught all of this, you didn't even have to catch the whole move. There is a momentum trade in here for you, right? To play off this. So 64.50, 64.45, right? All the way up there. It's another 60, 70 handles. For most people, they're just trying to catch a little bit of that. But if you know that this is a high sensitivity strike because it's short gamma, you can play into it, right? And take advantage of it. In the same way, if we didn't have a catalyst, maybe we just keep moving erratically, right? So that's the one thing you have to take with all of this is price action has to want it, and then you could play off the hedging effects of it. Yes. So just Jir, JPM collar no longer is correct. They moved to something called SME through the CME. I'm gonna talk with the guys in Youssef to see how they're going to show all of that. But it is no longer an SPX options trade. That is with fact now. I knew about it last week that they weren't going to do that, but until it became an actual factual data point, I did not want to mention it to anybody. But they're doing this to the CME exchange, and I'm trying to get more color and data from some of my friends who are higher up in the space on what the implications are of that. Therang, you've seen the last couple of weeks where price reacts to the gamma trough. So if you're talking about the gamma trough, you're talking about the yellow line. Is that what you're talking about, Therang? Not the blue line? Okay. Let me go. Let's just go back to today. Okay. So like the gamma trough represents areas that we call they call it low gamma influence is how it's set up on there. So they call it like the path of least resistance, where the underlying asset is less likely to encounter strong hedging pressure in relation to gamma as it pushes out or from the position itself. Okay, so you might see some reactions off of those lines. Absolutely, there's a reason that they're there. For me, the way that I kind of look at this is from a high quality trade perspective. I'm looking at gamma flip lines. I'm looking at positive gamma strikes, right, or the gamma peaks that come off, and the gamma flips. Okay. But sure, yeah, if you start to notice this, that's the art of the trading with a lot of this too, is seeing how things react, right? Gamma peaks, gamma flips. So that's what I'm looking at on this in this instance. So today, right, I know that we're in negative gamma until we flip up above these black lines. These areas usually act as support and resistance, or we get to this gamma peak that's sitting down here. Yes, I can, Joe. So we're going to talk now about charm. So this is one component. That's the basics of gamma and why it's important. And it's important for people to understand the hedging implications that are there. Okay. And then when we get into the positive side, sometimes that's where you get into gamma pins, right? Like if price was down here, let's say today, and we have this big positive gamma node, there's always the potential that as we catch a bid, it'll be a slow, grindy move up into what we would call a gamma magnet that's sitting at this strike up above. So we haven't been in that environment for a while. That's why we're not talking about those as much. But those are really great trades that you can take with flies, and there's different ways that you can kind of play it. Now let's talk about charm. So this is where we get more confusion sometimes on the charm side. Charm is probably even simpler to understand in my personal opinion. All charm is how the delta of the market maker's book changes with respect to time. Okay, so let's say on a 0 DTE basis that these were the positions that we had for today, right? That you guys can see. And let's say no one was buying or selling anything. We were just flat. There's no buying, no selling, and no one's changing their positioning. Charm would tell you what would happen as market makers hedged, right? So in this instance, with where we're at right now, Charm in the top left box here shows a value of 50, right? So we're looking at this from SPX. So it's a 2-to-1 when it comes to ES futures. So for every number that is in that box, a market maker has to hedge with double that amount. So if it shows 50, they're going to hedge with 100. Now, one thing to pay attention to is which side of the charm you're on. So on my map, I have custom colors, but anything with a positive charm value means the delta of their book is increasing. So they have to sell futures passively to offset the delta as it increases with time. And then vice versa. If it's a negative charm value, right, like you would see down here with 100, then their delta is going to decrease with respect to time. They have to buy futures, right? So this is where you get that passive selling. I use this as a way to see where the guardrails are for the day, right? And one thing to truly understand is the values can always be offset if they're not large enough, right? So this is like, we'll call it the wind, your headwind, tailwind that you would have, right? So I look for us to stay inside of these guardrails. So for right now, I would put the top here at 66.15. I'd put the bottom here at 65.41. There's usually a reaction at the charm flips, okay? If we get into them, then it changes like what has to happen. So here's the misconception. Just because they have to passively sell, like you see down here, doesn't mean we go down. When you look at the values, you have to understand how much selling they actually have to do. So in this case, with 15, that's 30 contracts over 5 minutes. I know people that trade 30 contracts in a 5-minute span, right? So the sizing of it matters. Now, net, when you get into a slower market period of time and the values are a little bit larger, right? Then you will have that type of wind effect. So you can kind of see it here. We slowed down. You get the slower effect that's going in. Now, obviously, if someone's coming in bid, there's not as much that you can, that you actually have to offset. Okay, so this is where price action always reigns supreme, and you're utilizing this data to give you things. Now, there's going to be other days, though, where the charm map is going to show you a move, and I think I can show you that on Friday, the 27th, like this, okay? And we traded this in with my group, but you have your pathways for the day inside the charm box, so you kind of have, and it's large. So I know all day we're basically going to be passive selling because from the bottom, 63.35 to 65.55, that's 200 handles. Unless positions come out from a 0DT basis to push out a passive or play supportive charm pocket, I know that there's going to be passive selling. So if price action doesn't want to go higher and there's not a lot of people buying, I know that slowly over time, we're going to keep chucking down, right? That's what we do. So you could see this here. Now, what we were talking about when we were trading is I am not going to just instantly off the open evaluate this information and say we have to go down here. Is it likely? Possibly. But I'm going to wait to see what happens throughout the day in the same way that you saw today, right? We gapped down. We're in suppressive charm. We have negative gamma, and we have buyers flying out of the gates. Price action's going higher. They're offsetting that wind from the charm, right? And they're bidding us higher. On this particular day, as time went on, I realized we're not passively selling here, and we're going to keep selling, right? So you could have sat here and traded this multiple ways: flies, long puts, spreads, any way. It's whatever flavor you like. And then when you see these values get really large, that's when your confidence level, can potentially increase. So for me, I noticed down here, these charm values get very large. So what I'm looking for is, okay, this says 160. And then when we get lower, now we're looking at 400. Okay, that's 800 futures they have to sell and towards end of day. And they're going to keep doing this over these 5-minute spans, right? So the trade for me, I think we got in around here and we played it. And then once we got down here, there was another charm pocket that popped up for a flip and we closed it on the flip line, right? So that is another way that you can evaluate this to be able to take those style of trades. In the same way that if you were trying to play like a gamma pin to the upside where we're in a stable environment, you'd want to see this to be blue. You could play a fly or something to the upside. Okay. Does that make sense? You guys understanding that aspect of it? I know this is a lot that I'm kind of throwing at everyone, but do you understand that basic concept? Think of it as like your directional guardrails and, where things, will probably end up, and they'll change as their 0 DT positions come in. What level of charm you find most meaningful? Yeah, it depends. I would say over 50, anything over 100. I prefer to see when we see large charm values end of day. Those are like my favorite to see when they're in the 300s. You just got to stare at it long enough and you'll start to, develop your own thesis off of it. Some people will see this chop and us going nowhere and they'll instantly buy for a trade down here, right? That's not necessarily how I do it, but that's the art of all of this, right? We know what has to happen from a passive side, from a gamma side, but price action has to still want it, right? So I'd say over 50, you could pay attention to it for sure. That's 100 over 5. And then on top of it, like 150, 200, 300 are the one I get a little bit more excited on this particular setup because you don't want to be wrong either, right? You're trying to put edge on your side. This is a game of probabilities. Tim, I do. I run a group called steamroomtrading.com. And we have a product called 0 Day that just trades intraday on the indexes all the time. Okay. And Joe, you are correct. If the value is 100, they have to sell 200. That is correct. So more selling to the close, and it changes. It's steamroomtrading.com, Tim. You can find me on Twitter under Joey Gex too, and you can see it inside of my bio. And then for anybody who's new coming into this, and you want to see this data and you want to play around with it and watch it, there's a 10% discount going on right now. I dropped it on Twitter as a reply to this actual stream. You can use code LIVE10 to get 10% off. To start playing around with it, and you can see the value of it, right? And one trade, like you saw with the caller, will pay probably for the entire year, if you use the data correctly. And we're going to keep doing these on Tuesdays and Thursdays to really drill in the basics for everybody and get into more advanced stuff as time goes on. Ron had asked if people want to follow your settings, there's a way that you could post them. Yeah, if you guys want my color schemes and stuff, I absolutely can give it to you, and you guys can look at this. So any other questions so far? You guys making sense on the value of all this and what you have to look at? Let you guys type out some stuff. Okay, no problem. Hey, that's why we're doing this, right? My goal is to just really dispel some of the incorrectness that people see and kind of put out online, because there's just been a lot of it, especially with the caller, right? And there's a lot of tremendous value in all of this and the way that I have found it when I come to trading. And if it takes 3 months to click and it's confusing, totally fine. I spent 2 years doing this, right? And I've gotten to the point now where it's mostly automatic in how I view most things, right? It takes time, and that's okay. Some people it'll click fast, some it won't. Some will just say, I don't want to do. That's all right. We're not here, to just say, hey, you have to do this and you have to do X, Y, and Z. It's really about educating and getting people to understand it. That's why, I'm a big fan of the founders over here at Options Depth and why I wanted to work with them. Okay, so that's the basics. Hopefully this kind of dispels some of the stuff. Obviously, guys, there's way more into this platform that you can get into. There's VIX positioning. You can look at all of the positioning across SPX on any strike or date that you want, from a market maker, customer position, the gamma. There's so much data that is inside of this, that you guys can make use of if you're looking for a little bit longer term plays over the next 5 days. Absolutely. But from an intraday basis, if you're not utilizing something like this, you're not going to know where the inflection points are. And be very careful, obviously, who you guys see and read on the financial Twitter space here, because there's a lot of misinformation that gets pushed around. Okay. If there's no more questions, we can kind of cut here. Again, live 10. If you guys want 10% off of Options Depth, check it out. I will get this recording sent over to the team, and they will upload it for everybody, so you guys can go back and look at it and keep reviewing the information that we talk about. And again, I'm usually every Tuesday and Thursday, and then talking about it every day on my accounts. So thank you guys for watching and tuning in. We'll catch you guys on the next live stream.